The European Central Bank decides on interest rates on Thursday, the 7th of September. At his recent Jackson Hole speech, ECB President Mario Draghi said that significant monetary accommodation is still needed. Dhaval Joshi joins us now from BCA Research. Interesting commentary around the interest rate meeting next week. First of all, what is your expectations from the ECB next week? With that comment from Mario Draghi, looking as though he's still wanting to retain low rates and this level of QE.
Yeah, he kind of wants to have his cake and eat it. I think that clearly they want to dial down this sort of emergency accommodation which they have, which is really inappropriate in my opinion for an economy that's growing very healthily when inflation is not, close to deflation. When you're seeing a lot of job creation, do you need emergency policy? But then if they escape it too quickly, then the markets will react aggressively, and that's what they want to avoid. So I think in terms of next week, they're not going to announce anything. I think it's probably too early. They said they were going to make some sort of announcement in the autumn, so that probably means the October meeting or even the December meeting.
What comes first? Is it a cut in, raise in interest rates or a cut in starting the tapering program of QE?
I think the tapering of the QE is most likely. And then quite possibly a one-off removal of negative interest rates sometime next year, because I think negative interest rates, again, seem wholly inappropriate at this point of the economic cycle. And then probably in 2019, raising of the mainstream interest rates. They have three interest rates. It's the deposit rate that's negative, and that's the one that probably will be raised first at some point next year.
Yeah, I want to take a look at the effects of negative interest rates in just a minute, but I want to talk as well about the strong euro. And if we bring up a chart of euro dollar, you can see the way in which we've come off this low level that we saw at the back end of last year, which around about 103.5 euro dollar level. Here we are now at just shy of 120. We've heard some anecdotal evidence that this strong euro is affecting some parts of the eurozone's economic performance. In your mind, is that really happening, or are we this is just a canary sort of telling us that there are some problems out there and it's only going to get worse?
No, I think that there's too much focus on the headwinds of a stronger euro, but no one really mentions there's also tailwinds. And the biggest tailwind is on consumer spending, because as the euro strengthens, effectively European consumers and households are richer in terms of what they can buy globally, in terms of items that are traded on the international markets, most notably energy and food. Now, bear in mind that Europeans import their food and energy, so suddenly they can import a lot more, or it's cheaper. I think that's probably the better way of looking at it. Food and energy is an inelastic spending item. You don't change the amount of food or energy you tend to use. As the price drops, in euro terms, you have more money to spend on other items, and that boosts consumer spending. So on the one hand, exporters get hit, but consumers benefit. Net, I don't think it's a negative to the economy.
Well, that itself is a conundrum, isn't it? That's behind the conundrum for the ECB is the fact that they're importing low prices, so inflation isn't as high as they need it to justify their program of removing accommodation. So it's a very difficult one.
It is a difficult one. I think that if you look at core inflation, that's sort of stable at just over 1%. So again, this is not something we should be desperately worried about. I mean, this fixation with 2, I think is a bit of a problem. 1% inflation or 1.2% inflation, what's the big deal? That's actually a good place to be. I think they want to sort of build in the sort of margin of error, but at what price? You're creating distortions by fixating too much on this so-called magical number of 2.
Let's take a look now at that point you mentioned about negative interest rates and wanting to remove that. What has been the effect of negative interest rates? Where have we seen it most impact most in the economy?
Well, I think that paradoxically, I think that the bubble that the ECB have created might actually be in a neighbouring economy in Sweden. So you look across the Baltic Sea, the Riksbank have had to shadow the ECB, right? Because otherwise the krona is going to go up like crazy. So the Riksbank have been also pursuing this sort of negative interest rate policy. the Swedish economy, in the meantime, has been growing at around 4% recently, 4.5%. I mean, is that really right? Negative interest rates and 4.5% growth. And the other point, of course, is house prices in Sweden have gone up 50% in about 3 years. So that's where you're sort of seeing potential distortions and the start of financial instabilities. So what I'm saying, negative interest rates, low interest rates, it's not a free lunch. There's a cost somewhere. And I think that the Riksbank are sort of quite worried about this.
And how about the argument that as well, equities have been pumped up to unrealistic levels because of all this QE? Do you subscribe to that?
I do, but I think that's a sort of a broader point about global QE rather than European QE. Certainly, I think there's this idea that central banks will do whatever it takes to sort of prop up equity markets, and I think that's created quite a lot of complacency. We look at this very low volatility. To me, that's not a good sign. That's a bad sign. Low volatility just means that markets are very high. It doesn't mean the risk is low. There's a very clear correlation. The higher the market goes, the lower the vol goes. Some people think that's low risk, but it isn't.
Yeah, we hear a lot as well about low interest rates and the banking sector in particular, because the lower interest rates are, the less margin they can get, so less earnings they have. Do you see any stress in the banking sector at the moment? Is the banking sector somewhere where you would rather not be?
Not really, because I think that for the most part, banks are recapitalised across the world. I think the one area which still needs further recapitalisation is Italy. They kind of missed the boat. Spain had a crisis, they had to recap. The same in the UK, same in the US, same in Ireland. Italy didn't have that crisis, so they didn't recapitalise their banks. They're doing it now. It's a slow process. That's the area of Europe where I think the banks are still in need of some help, but I think they're heading in the right direction. But overall, I don't see any sort of major risk in the same way in 2008, because policymakers have been aware of that sort of problem and have addressed it. I think the next problem will come from somewhere else.
Right.
It'll be a different type of problem, because you always sort of fix the old problem and a new problem comes along.
Any hints as to where that could be? What's your research shown up?
As I say, in financial markets, people have confused low volatility for low risk, and that's a mistake. So risk premia are too low. I'm not saying that's an imminent problem, but I think that's where the instabilities are building up.
So how do you trade all this? I mean, what are the keen trades to be taken out of this?
Well, I think on the euro, certainly you could have a short-term setback, because I think the ECB will say, look, we're not going to do anything too rapidly. We may taper next year, but it's going to be sort of quite a dovish tone of the meeting, in my opinion. So there'll be a bit of a setback. But thereafter, I think the uptrend in the euro continues, because you're not even close to fair value.
Where is fair value in your mind?
Well, I think even in the ECB's mind, it's if you look at the ECB's own models of competitiveness, they say that the euro needs to go up into the sort of mid to high 120s against the dollar before the euro area as an aggregate is at fair competitiveness. So that's the point where you're saying, right, it is genuinely expensive as an aggregate. Now the problem is that within that, Italy is already slightly under-competitive. Germany is still massively over-competitive. So the average hides the spread. So I think once you're into the mid-120s, you could say, look, it's now where it should be. So I think there is a little bit more cyclical upside, but you probably don't want to, you don't want to be sort of long tactically into the meeting, because there could be a little bit of a setback.
You mentioned Sweden. How are you positioned on the Swedish krona?
Well, again, I think I'd be cyclically long, because as the ECB backs off, that liberates the Riksbank to remove its own aggressive negative interest rate policy, which it must do given what's happening in the housing market. So I would say I'd actually prefer the krona to the euro. Krona dollar is probably long Swedish krona versus the US dollar is probably the favourable, the preferred trade for me. Conversely, I would avoid plays on the Swedish housing market. Avoid short the real estate stocks in Sweden, and just be cautious of house prices and the housing market in Sweden.
Okay, all right, Dhaval, thanks for joining us. Dhaval Joshi there from BCA Research. Ahead of the interest rate meeting from the European Central Bank at Thursday, the 7th of September.